Hey everybody, it's Random and welcome back to the channel. Today, we're diving headfirst into the world of investing, specifically focusing on the stock market. The stock market is essentially a giant marketplace where you can buy and sell pieces of companies known as stocks. Think of it like owning a tiny slice of your favorite company, like Apple or Tesla. By the end of this video, my goal is to equip you with the knowledge and confidence to start your investing journey. We'll break down complex concepts into bite-sized pieces so you can make informed decisions about your financial future. No more feeling lost or intimidated. Let's demystify the stock market together. Let's kick things off with the basics. Stocks. In simplest terms, a stock represents a piece of ownership in a publicly traded company. When you buy a stock, you're essentially buying a tiny slice of that company. Imagine owning a minuscule portion of Amazon, Apple, or Tesla. That's the power of stocks. Now, you might be wondering, how do I actually buy and sell these stocks? Well, that's where stock exchanges come in. Think of them as giant auction houses for stocks. The most famous ones you've probably heard of are the New York Stock Exchange, also known as the NYSE and the NASDAQ. These exchanges act as platforms where buyers and sellers from around the world come together to trade stocks. But what determines the price of a stock? Why do some stocks skyrocket in value while others plummet? Well, several factors influence stock prices, and understanding these factors is crucial for any investor. First and foremost, a company's performance plays a significant role. When a company is doing well, generating strong profits and exceeding expectations, investors get excited and demand for its stock goes up, driving up the price. On the flip side, if a company reports disappointing earnings or faces setbacks, investors might lose confidence, leading to a decline in stock price. Beyond a company's internal performance, industry trends and overall market sentiment can also impact stock prices. For example, let's say there's a surge in demand for electric vehicles. Companies in the electric vehicle industry like Tesla are likely to see their stock prices rise as investors anticipate future growth. Similarly, broader economic factors and market sentiment can create waves that affect stock prices across the board. Remember, investing in stocks is a long-term game. Now that we've covered stocks, let's move on to another essential asset class, bonds. While stocks represent ownership in a company, bonds are a different beast altogether. In essence, bonds are loans that you make to governments or corporations. When you buy a bond, you're essentially lending money to the issuer, who promises to pay you back the principal amount plus interest over a predetermined period. Here's how it works. Let's say a company needs to raise capital for a new factory or expansion project. Instead of issuing stocks, they can issue bonds. Investors like you can purchase these bonds, effectively lending money to the company. In return, the company agrees to make regular interest payments known as coupon payments to bondholders like yourself. These coupon payments are typically made semi-annually and provide a steady stream of income. Now let's talk about some key features of bonds: interest rates, maturity dates, and bond ratings. Interest rates on bonds are influenced by several factors, including prevailing market interest rates, the creditworthiness of the bond issuer, and the bond's maturity date. Generally, bonds with higher interest rates carry more risk, while bonds from more reliable issuers tend to have lower interest rates. Maturity date refers to the date when the bond reaches the end of its term and the issuer is obligated to repay the principal amount to the bondholder. Bonds can have varying maturity dates, ranging from a few months to several decades. Typically, bonds with longer maturity dates offer higher interest rates to compensate investors for tying up their money for extended periods. Bond ratings, typically provided by credit rating agencies like Standard & Poor's or Moody's, assess the creditworthiness of bond issuers. These ratings provide investors with insights into the issuer's ability to repay their debt obligations. Bonds with higher credit ratings are considered less risky, while bonds with lower ratings carry a greater risk of default. Bonds can be a valuable addition to a well-diversified investment portfolio, providing stability, income, and a lower risk profile compared to stocks. Now let's dive into the world of mutual funds, an investment vehicle that has gained immense popularity for its simplicity, diversification benefits, and professional management. In a nutshell, a mutual fund pools money from multiple investors. like yourself, and invests in a diversified portfolio of assets such as stocks, bonds, or other securities. Think of a mutual fund as a basket of investments. Instead of buying individual stocks or bonds, you can buy shares of a mutual fund that aligns with your investment goals and risk tolerance. Each share of the mutual fund represents a fractional ownership in the fund's underlying portfolio of assets. One of the most significant advantages of mutual funds is instant diversification. By investing in a mutual fund, you gain exposure to a wide range of assets, reducing the risk associated with putting all your eggs in one basket. Another key benefit is professional management. Mutual funds are managed by experienced portfolio managers who make investment decisions on behalf of the fund's shareholders. These portfolio managers conduct extensive research, analyze market trends, and actively manage the fund's holdings to strive for optimal returns. Mutual funds also offer unparalleled convenience. They handle all the administrative tasks, such as buying and selling securities, tracking performance, and distributing dividends, making investing hassle-free for individual investors. Now let's explore some different types of mutual funds. Index funds, actively managed funds, and exchange-traded funds, ETFs. Index funds are designed to track a specific market index, such as the S&P 500 or the Nasdaq 100. These funds aim to replicate the performance of the underlying index by holding the same securities in the same proportions. Index funds are known for their low fees and passive investment approach. Actively managed funds, on the other hand, have portfolio managers who actively buy and sell securities within the fund's portfolio to try and outperform the market or a specific benchmark. Embarking on your investment journey can be both exciting and daunting, especially if you're new to the world of finance. But fear not, aspiring investors. I'm here to share some invaluable tips to help you navigate the market with confidence and make informed investment decisions. First and foremost, before you even think about investing a single dollar, it's crucial to establish clear investment goals and determine your risk tolerance. What are you saving and investing for? Is it a down payment on a house, your dream retirement, your children's education, or a combination of goals? Defining your investment objectives will guide your investment strategy and help you stay focused on the long term. Once you have a clear understanding of your goals, it's essential to assess your risk tolerance. How comfortable are you with the possibility of your investments fluctuating in value? Are you willing to stomach short-term losses in pursuit of potentially higher long-term returns, or do you prefer a more conservative approach? Your risk tolerance will determine the types of investments that align with your financial personality. Now, with your goals and risk tolerance in mind, it's time to educate yourself about different investment options and strategies. Don't worry, you don't need to become a financial expert overnight. Start by reading books, exploring reputable financial websites, and considering financial education courses or workshops. The more you learn, the more confident you'll become in making informed investment decisions. One of the most fundamental principles of investing is diversification. Remember the saying, don't put all your eggs in one basket? Well, the same applies to investing. By spreading your investments across different asset classes such as stocks, bonds, and real estate, you can reduce the impact of any single investment on your overall portfolio. Investing is a long-term game, not a get-rich-quick scheme. Avoid the temptation to time the market or chase after the latest investment fads. Instead, focus on building a diversified portfolio of quality investments that align with your goals and risk tolerance. Remember, time is your greatest ally in investing. The earlier you start, the more time your investments have to compound and grow. We've covered a lot of ground today, from the ins and outs of stocks and bonds to the power of mutual funds and essential tips for beginner investors. Remember, investing is not reserved for the wealthy or financially savvy. It's a journey everyone can embark on to build a more secure financial future. The key takeaway is to start investing as early as possible, even if it's with a small amount. The power of compounding, combined with a disciplined approach and a long-term perspective, can work wonders for your wealth-building journey.